Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today's episode is going to be another great one. We're going to talk about active management in some attractive areas in the market where actively managed investment strategies shine. And lucky for us, I have on the perfect guest to talk about the topic of active management. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and very excited to welcome Mark Goodwin. Mark is the CEO of North Square Investments. Mark, thank you so much for coming on the show. It's really an honor to have you on. Can you please tell us a little bit more about yourself and North Square Investments?
Happy to, Ryan. Thank you for having me on. I started my career as a CPA working for Ernst & Young a long time ago. A lot of clients in financial services and some other industries. I really cut my teeth in financial services for over a 20-year stretch working for Putnam Investments and then Pioneer Investments in the Boston area. And during that time, I spent a lot of my day-to-day in launching product and performing M&A, working on launches and dealing with the entire ecosystem regarding strategies that we're trying to bring to market. And during that time, it became obvious that we were spending a lot of our time defending legacy book of business. We started at Pioneer as a large cap equity manager with the third oldest mutual fund in the country back in 1928. And over time, passive arose and started to eat away at our, the core elements of what we're doing. So from at the end of my time there, I thought, wouldn't it be neat to have a blank sheet of paper where you could bring to market strategies that people want, as opposed to going where the puck has been, focus on where the puck is going. So that gave me the idea of starting a new multi-boutique firm now, North Square, which we're focused on three primary asset class areas: interesting fixed income, international and global equities, and then what we call specialty strategies, which could include alternatives, but for us, we would throw in that bucket small cap equities, tactical allocation, things that are non-correlated like insurance-linked securities, as well as traditional alternatives. Mm-hmm. With that third bucket really focused on categories that are typically capacity constrained, and if a manager can do well, they can typically generate significant alpha, and you can charge a decent fee for the privilege of doing so. So that was the backdrop of the idea for North Square. We launched in 2018 with backing from a private equity firm, Estancia Capital, as well as some well-known industry veterans who joined us as board members, as investors. And as of year end, we finished with about 13 billion of platform assets at North Square, around 9 billion on the institutional side, 4 billion on the retail side. And of the retail assets, evenly split between SMA, UMA, model delivery, as well as mutual funds, and our first ETF we launched in December as well. I'd also add that we presently have 6 5-star mutual funds as rated by Morningstar and 1 4-star fund. So given that we're 6 years in, we've done a decent job in developing some interesting active solutions.
Mm-hmm. I'm glad you brought that up, Mark, especially with their SMAs. As part of Zephyr is the PSN SMA database. You guys contribute to it. And also, I always see them as top performing strategies when I'm doing Top Guns and the Top Gun commentary. So you guys are doing some fantastic work over there on the performance side. And I'm really glad you brought up passive, right? Deep down, I tend to be side more on the active side. I believe in, trying to find alpha, like you said, and outperformance. But, passive is like you said, it's gaining a lot of market share. And, where do you see that going? I know you said you're going to where the puck is going, which is fantastic. And one of the other spaces there is active ETFs. How do you see active ETFs playing a role in active management?
Sure. So just to take a cut at the universe today, I'm going to focus on commingled vehicles. there's roughly 30 trillion in fund assets today, roughly 20 trillion in mutual funds and 10 trillion in ETFs. And within the 20 trillion of mutual funds, probably 45% is in large cap equities. That's the area that's being most challenged by passive. If I look at the 10 trillion we have in ETFs, probably as of Q3, 92% of that is passive. So 9.2 trillion out of 10 trillion is passive. And I think that's capturing a lot of the flow away from active mutual funds into passive ETFs. So 92% is passive, but there's 8% of the ETF universe, or about 800 billion as of Q3 of last year, that's active. And I can divide that bucket into probably 3 or 4 sub buckets. We have those things that are crypto related. That's probably 20-25% of the pie. Didn't exist 5 years ago. I'm not sure if that really enters into the broader equation of active versus passive. It's just a new thing, and we can save that for another day. Another quarter of that pie is dividend enhanced yield strategies, kind of like JP Morgan's JEPI, where you've got dividend yielding equities that are being enhanced by derivatives or ETNs in that example. And then of the remaining bucket, you have some strategies that are, I'll call them light active or enhanced beta tilts, where DFA is a big player in that space, but there are many managers that are bringing strategies to market that are technically being called active. Aventis has a small cap value fund they brought to market that has several hundred stocks in it, and in a turnover that's probably 3-4%. So it's active in the sense that there's some degree of beta tilt, but the number of securities it holds as well as the turnover makes it kind of walk like an index fund. So it's kind of like active light, if I could term it, even though Morningstar refers to it as active.
Yeah. Mark, you brought up a really good point, and this will be a lot of our conversation, but when you talk about large caps, whether it's large growth or large value, and that's really where passive is taking a lot of the market share from, those are two, in my research, leveraging Zephyr, those are the really large growth, blend, and value, the 3 hardest spots to find alpha or outperformance, because markets are efficient there. There's not a lot of inefficiencies. So it's not really surprising that you brought up those numbers that say that's where passive is outperforming or taking market share from activism in a large space. And then it brings me to the point also, if you're investing in a spider or large growth ETF, you got to understand that 30% of that portfolio is going to be in the big mega tech names. So there's not a lot of diversification there. Can you take advantage of that as an active manager?
Well, I think the 3 areas that we focused on, interesting fixed income, international, and some of these specialty strategies that are small caps, for an example. If I look at fixed income, the majority of fixed income strategies and mutual funds are 100% active. There is no passive in multi-sector. There is no passive in high yield. So within the fixed income space, active is alive and well in mutual funds, and that's an area where we can play. Within the broad equity space, we believe that you can still generate alpha consistently in the small cap areas, and are focused on that with some of our offerings. So we're not trying to play in the most competitive space, where I agree with you, it's hard to win when the Mag 7 is driving most of everything out there. But we think there's thoughtful ways of allocating your book of business across the style boxes and trying to take advantage of where alpha can be generated in a consistent fashion, and try to spend your time there and perhaps leave those larger spaces to passive.
Yep, for sure. I often say, a lot of people, it's active versus passive. It's very exclusive. And it's like, I don't think so. I think when you're building an investment portfolio, why not have a conversation that they can all work together? They can be inclusive, like you said, do active in the small cap space, multi-sector, maybe use passive in those large cap spaces. So it should be one of those conversations where it's not one or the other, but maybe both.
Yeah, there are more levers today than there have been ever in terms of how you build portfolios along the efficient frontier. and perhaps using a more passive approach to something that's vanilla, and barbell. It gives you the opportunity to put more of your risk budget in things that could potentially give you a lot higher returns overall.
Exactly. Yeah, I love it. I love these conversations about really getting down to the portfolio construction and investment management. There is a lot of ways to slice and dice an active manager's performance when conducting a manager due diligence. It can be like alphabet soup in some ways with all the different analytics. What are some of the primary qualitative and quantitative characteristics that you and your team look for when conducting a manager due diligence?
Yeah, so if we're looking for a manager to partner with, and we have 8 current affiliates in the family, we start with performance. Can you put up consistent performance over a long period of time, ideally 10, 15, 20 years? And that's top quartile to top decile, measured by any of the independent, major data providers, be it, Morningstar or eVestment, et cetera. And then from there, making sure the pedigree of the firm holds water. The people on the team ideally have worked together for a long period of time, and there's no turnover. And then we spend a lot of time on process. It's great that you put up your numbers, but I need to make sure that I think that you're not just lucky, that you're actually good and can continue to do what you're doing over a long period of time. So we take a lot of time working on portfolio construction, performance attribution, trying to understand what gave rise to performance in different periods, and even in certain down periods, did you perform in a negative way, in a way that we thought that you should. Other things we look at beyond the hard numbers are, is there a secret sauce to what you do? I know you're managing, and I'll make up story. It's an EM debt, or it happens to be a small cap international strategy. Do you have something differentiated from your peers that we can point to that is likely to be an alpha generator going forward? Maybe it's your expertise in frontier markets. We have no EM debt, so I'm just using it as an example. And then from a secret sauce standpoint, we look to the ability of the team to be able to tell the story. And sometimes managers are exceptional, and we actually think they have a good process and something special in what they do, can't talk their way out of a paper bag. And we think it's really important for the PMs themselves to not insulate themselves with client PMs or something, but be able to go out there and articulate the process, how they do what they do, and be able to give a backdrop about how it performs in different market regimes and why it could play a potential role in your portfolio. So it's really a holistic of the 4 Ps: people, process, performance, pedigree, special sauce, and then the ability to tell the story. And hopefully they're good guys and want to travel with us and have some fun as we try to market.
Maybe that's the most important part, right?
And that's clearly part of it.
I love that conversation. There's so much to unpack there. We could talk about the analytics piece, those hard numbers, which really, to be honest with you, is kind of the easy part, right? Sharp ratio, good or bad. And then I like to really focus on, you talked about risk, downside deviation or downside risk. How do you minimize that risk? Preserve your assets, so when the market does recover, you've got more assets to participate in the recovery and so on. But the hard part is more that qualitative side that you mentioned, in the secret sauce and the processes. It takes more time, and a lot of people, financial advisors, don't have access to that information. So I'm glad you brought that up. And then storytelling. We at Zephyr, we help a lot of asset managers try and tell their story. But it's not, and you said it perfectly, it's not just about telling a story. You got to do it really well. Everyone has a story. You got to be able to tell that story really well. You got to be able to use data to back it up, and make sure you're using the correct data to do it. So I'm really glad you brought that storytelling up, because you need to articulate it like you said.
Well, sometimes managers that we're chatting with will follow for a long period of time, maybe a year or two, or more, to see that they continue to do what they do. And sometimes we won't work with a manager because they're putting up good numbers, but we can't determine why, or if there's a process element to it that can be replicated. So patience and continuing to work with the manager over time is critical too, to assess that they have the right stuff.
Is there things in that storytelling process that you specifically look for? I know you had mentioned, well, is it a good story? Can they articulate, or is there different specific pieces of a story that maybe raise some red flags?
Yeah. Well, I'll give you an example. I was chatting with a manager that we didn't partner with, based in Europe, and they run a global bond portfolio that has great numbers, consistently top quartile, and the process uses, in theory, AI, and some element of sustainability in assessing the sustainability or improving sustainability of the, call whatever, the carbon footprint of the issuer of the bond. Now, that in Europe, that's a big thing. Everyone wants to have, ESG, or the sustainability aspect of the marketplace is popular. I couldn't determine well enough, is the sustainability a driver of alpha? Is the use of AI a driver of alpha? Or are you just good credit managers? And these are two, shiny keys to show the marketplace that, hey, we're green, and we're using AI, which is a hot button today. And we didn't pull the trigger. We didn't move forward. We're still watching, but it's we again need to have the attribution bear itself out. Otherwise, I won't bring something to market that I can't feel comfortable about myself.
Very interesting in that whole ESG. Mark, we could have a whole episode on ESG.
That's another 2-day show.
Yeah, exactly. And it's kind of interesting, I don't want to change the subject here, but it's interesting that they market AI and ESG, because a lot of people say AI for how much energy it takes and stuff like that. Is it really, sustainable?
I don't want to dismiss someone, because sometimes someone does have a secret sauce and you don't know it yet. So we're probably chatting with 2 to 5 managers, new managers every week, because you just don't know. And of the whatever 200-300 a year that we chat with, 3 or 4 might have some gold in their process. So we'll keep turning over rocks.
Yeah, fantastic. So you mentioned small caps is one area where you like. There's opportunity to find alpha there, alpha generating managers and strategies. And that's where some of your best performing strategies are at. Why do you like the small cap space? What is it that makes it attractive in your mind?
I think probably a series of factors. One, there's less analyst coverage for the space, and within small, I'll include small to micro caps, where some of these strategies might not be followed by anybody, or there's one analyst, and so you have to do your own research. Where if you're dealing with large caps, you've got 200 analysts covering Verizon or something, so the odds of you finding something new in their conversations are less likely. There's greater access to management. They're more likely to take your call and help you understand what's going on with their company, or not. The law of large numbers kicks in sometimes when a success starts to run. So working with someone in the small space, if you're catching someone when the wave is about to take off, you can ride that. Where you just don't have that same ability to have a multiplier effect when you're in the larger cap space. So I think it's an area that's less traveled, that really good PMs can show their stuff, and the potential for outsized alpha has been borne out over time. So we remain high on that. We've got a couple of 5-star funds in that space today, and are going to continue to focus on it as a great area to bring product to market that can benefit our clients' portfolios.
Fantastic. And I'm glad, inefficiencies, market inefficiencies, trying to find those inefficiencies. And like you said, that's one area where maybe there's more inefficiencies that are easier to find without less competition. How about the macro backdrop today that, we got tariffs and all this information? Inflation is higher, just released that. How does that impact small caps right now?
Well, I think from a tariff standpoint, you would think that they would be less impacted unless they were in a tariff, product area, because they're not a global multinational that might get picked up with broader energy cost or steel if they're manufacturing something that's heavy industrial. So I think they're probably going to sidestep a lot of the broader macro tariff related things. They're not immune to inflation, as is everyone. If they're in a high growth area, they may have pricing power that larger firms don't have. So we find a lot of our small cap opportunities are nichier in terms of their end product offering to their clients, in which case may have some pricing power that the broad multinationals may just not. So not immune from pressures, but in some ways maybe more nimble to be able to sidestep some of them and drive growth despite the broader market backdrop.
Mm-hmm. Fantastic. And moving along with fixed income, you mentioned multi-sector as a fixed income space that is attractive for fixed active management. What's going on there that makes you, again, find it an attractive place for investors?
Yeah, so if I look at flows, mutual fund flows in January, the highest flow category was multi-sector bond with 2.9 billion of inflows in January. It's been in the top 10 for a while, and it's all active. There is no passive. I like that category in particular because it probably allows a fixed income manager the most flexibility to show their ability to drive alpha. Mm-hmm. And beyond just credit or duration plays, relative value across sectors can be displayed. Their ability to assess relative value. Currently our managers have a favorable view towards CMBS, where they think that the whole commercial real estate noise has been overplayed a bit, and if you do your credit analysis, you can win in that sector that the names are screening cheaply. Other agency MBS are appearing favorable as well, but sometimes these windows open and close, and within a multi-sector manager's toolkit, you can go in and out of these things as you see fit, where if you're stuck managing against pure ag and have to stick in your swim lanes with treasuries and corporates, there's not a whole lot of leverage you can pull to drive alpha. So we like that space a great deal, and it's probably the single largest category where we believe that a fixed income manager can demonstrate their prowess.
And that's the space, really, going back to where you do your due diligence, right? You got to focus on the process, the people, because like you said, there's so much flexibility in the multi-sectors. Is what are they doing? What's driving performance, and what are they doing well?
Yeah, and then trying to track them over time, like looking at a lava chart of where they've gone in and out of the market, can really demonstrate that they're, maybe they were in EM debt until it wasn't good, and then they were in, bank loans, pivoted out of it, were deep into preferreds, and then moved out. Or it's truly the number of levers are I don't want to say endless, but are numerous. And by looking at a back model over time as to where they've deployed their capital and looking at performance attribution kind of layered over a lava chart, you can really see if someone's got the mojo or not. The other thing that's interesting is that most of these are not the same. Someone might be super good at munis and oddly will play in the muni space, even though it's a taxable bond category. Someone else is super good in high yields or structured credit. So you get, it's like the Cracker Jack box. You're never sure what you're going to get. So take a look at each one, and you might see very different return profiles, and I think you'll find some interesting ways to supplement your clients' portfolios with one or two of these.
Yep, and like you said, it really look at it with all the portfolio pieces to see how well they play together, where is their diversification and so on. You mentioned preferreds. What's your thoughts on preferreds? I've had some conversations lately, quite a few of them actually, on preferreds. What's your thoughts on preferreds moving forward?
Yeah, I recall reading LPL's outlook piece for the year, and preferreds is one of their fixed income categories, perhaps their only one that they're overweight on as a favorable. We like preferreds in general for a few different reasons. it's a niche category as a hybrid security. So folks that play in that space, and one of our affiliates, Red Cedar, is I consider
Yep.
a very strong performer in that arena. You can get alpha through knowledge of corporate structure and where things sit in the cap stack, and also understanding the structure of the vehicles themselves and how they get unwound, and what are the orders of protection and bankruptcy and whatnot. So there's kind of structural alpha you can get from that space that would not be present in buying a vanilla corporate bond issue. Other things that are attractive about it, looking over time, something called the Sherman ratio, the ratio of yield to unit of duration taken, and preferreds have compared favorably to corporates over time in terms of yield to unit of duration, as well as in recent past high yields as well, to the point where you might, if you're looking for yield, you might get not the same yield as high yield, but close or pretty close, and you're not taking the credit risk that you're taking with high yield. So for those that are retirement oriented investors that need yield, trying to understand where the yield is coming from, and is it worth the credit risk you're taking to get it? The last thing I'd say about preferreds, in contrast to other fixed income securities, they have the ability to generate some interesting tax advantaged outcomes. So there's something called qualified dividend income, QDI. So if the securities that are being invested in are designated qualified dividend income by the IRS, and you hold them for a designated period of time, you can get effectively QDI treatment, or in other words, capital gains treatment for something that might be otherwise ordinary income. And just this December, we launched our very first ETF, a qualified tax advantage preferred income fund, it tickers QTPI, that focuses on generating not highest total return preferreds, highest tax advantage yield from the preferred portfolio. So in some sense, it could be another play to supplement your muni portfolio, where you've got a higher yielding tax advantage play that could supplement your tax advantage muni yields nicely.
Fantastic. That tax management, I think, is when I started in the industry, yes, you talked about tax management 20 some years ago, but it's really picked up recently, and a renewed focus on reducing those tax obligations. And I'm really glad you brought that up with preferreds. I'm not sure it's really talked enough about one of the benefits of preferreds in that strategy.
I think it's a hidden benefit, and one that I think that we're trying to raise awareness of, and I think it may resonate well in the ETF space.
Yeah, fantastic. I'm glad we tied it all together there, Mark. Great job. Started, kind of talking about ETFs and passive, and now
we brought it full circle. We did okay.
Yeah. Well, I could tell you are a host of your own podcast, Mark.
Try to keep us on track.
Yes. Mark, I like to end, we've got a few minutes here, and each episode, if there's time, with a fun story. It could be you're in Chicago, it could be something centered around Chicago, it could be sports, or it could be business related. It could be something that you just find really odd or interesting in the market. Anything fun going on or interesting that you want to share?
I was thinking about that when you set the note around, and maybe as a frequent traveler, I travel every week, and I'm on planes, and I'm always amazed at the odd array of things that happen to you. And I've had people vomit next to me and spill their their drink on me, put their water bottle on the overhead bin and have it leak on me. And so those are things I'd like to avoid. But this past week, I had experience of the plane actually fully load, everyone load, and they have the announcement saying, well, we didn't do a security check. We need to completely unload and redo this again, Groundhog Day. So not completely funny, but I think travel breeds you with a variety of interesting experiences, requires your patience, but I've never had that happen before. And I'm like, okay, we're delayed often for weather, but let's do a redo.
Yeah, it's well, like, whether they can't control, but some of those things, and I often wonder, and obviously, years ago, travel was easier. There wasn't TSA and stuff like that. But do you think traveling has just gotten worse over the years, or maybe it is just more efficient, or because more people are traveling?
I think they've the airlines have gotten more efficient in terms of packing their planes. So the planes are often smaller or right sized to the number of people they have, so they're full constantly. And I would say I'm flying two plus routes a week every week, and I'd say the planes are full 90+% of the time. So efficient for them in terms of utilizing passenger miles. But there's no slack if it's hard to pack all the overhead bins since they're always overflowing. But it's probably a good sign that the economy's
Yeah.
working for us. The restaurants seem to be full and the flights are full. So hopefully that bodes well for 2025 and beyond.
Yeah, fantastic. Mark, such a fun conversation. Thank you so much for coming on. It's a fun topic too, investment analytics. Um, Really fun. I enjoyed it. Thank you so much for coming on the show. It was an honor. Where can our audience get more information about North Square Investments?
Sure. You can go to our website, northsquareinvestments.com, and learn more about our strategies and check out some additional material on us.
Awesome. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. And lastly, please give us a follow on the Zephyr LinkedIn page to get more insights from Zephyr and research. Thank you very much and have a great rest of your week.
Thank you.
Mark.